And in our top business story, the fiscal deficit in the Arabian Gulf region is expected to widen to 12.5% of regional GDP this year as low oil prices eat into government revenue. The assessment came from ratings agency Moody's, who are predicting that the fiscal deficit will widen from 9% last year as the international oil benchmark Brent has lost nearly 65% of its value to about $41 a barrel since mid-2014. In the report, Moody's analysts stated that lower public spending is likely to weigh on economic growth this year, adding that lower oil prices will also affect GCC public finances, eroding their fiscal reserve buffers and increasing debt levels, with the GCC also increasingly viewed as a two-tier region. Some countries, including Saudi Arabia, have indicated that they plan to tap the international bond market this year to help plug their fiscal deficits. This month, Moody's put Kuwait, Saudi Arabia, the UAE, Bahrain and Qatar under review for a cut. The rating for Bahrain was downgraded and also placed on review. Oman was cut for the first time by Moody's last month, and the rating is also under review for a further downgrade. Moody's expects the fiscal deterioration in Saudi Arabia, Bahrain and Oman to be faster than in the UAE, Qatar and Kuwait because of the ample reserves that the last three countries have, which will give them time to adjust to a low oil price environment. And GCC governments in the region have to look for alternative ways of generating capital to fund the planned projects. That's according to economic experts speaking at the MEED Financing Projects in New Oil Era conference. Alternative sources of funding, as well as bridging the budget deficit gap, remained the top discussion during the one-day forum, which was attended by over 100 experts from the financial, banking and real estate industries. While discussing the geopolitical scenario and the economic outlook of the MENA region, industry experts stated that governments should adapt to new project fundraising methods while also looking at retaining local capital as much as possible. The GCC region has traditionally been self-sufficient in funding mega projects. However, with Brent crude currently at just above $41 a barrel, experts recommended that governments should focus on public-private partnership funding model, which has been successful for water and electricity projects for other sectors, such as real estate development. While stating that oil price isn't expected to reach $100 a barrel over the next few years, experts added that local banking sector too is facing the liquidity freeze, and other funding methods such as selling offshore assets can provide the necessary funds.
You're seeing a little bit of a squeeze in liquidity in the banking system. Some of those deposits have gone out. Oil prices may well be bottoming out, but the thing is, I don't think they're going to get anywhere close to $100 a barrel in the next 5 years, certainly. So the question for the governments in the region is how can they rebalance their economies? How can companies in the region rebalance away from relying on cheap capital, cheap fuel, and become more efficient? Well, there's a number of things. I mean, you can use bank loans, just vanilla bank loans to the central government. You can do project financing, which we've been talking about today. There's also going to the global bond markets. I mean, the region really has little exposure to global bond markets. That's obviously an easy option, and I think there is interest in buying bonds in these highly rated economies.
According to a recent study by MEED, there are currently more than 120 project-financed schemes worth more than $110 billion, either planned or under construction in the GCC region. It was added that as the oil prices fell in 2015, the value of project-financed schemes increased substantially to $14.3 billion, compared with just $2.6 billion the previous year. According to a representative from MEED, governments are increasingly turning towards innovative financing methods such as project bonds, sukuk issuances and export credit agency financing to fund projects.
Currently in the MENA region across Middle East and North Africa, there are about $42 billion worth of projects seeking project financing. So last year, around about $30 billion of project finance was raised for projects. Currently in the pipeline, we have $42 billion. So there is an increased demand to raise finance from whatever sources to fund project investment. The conference today is looking at what are those sources, how can we get that borrowing. One of the main areas is what we call public-private partnerships. So that's using private sector finance working together with government to deliver public infrastructure and public services. And the region has had a lot of success with PPPs in electricity and water sector in the past. And that is because of the nature of those markets. The government is a single client and much easier to structure. Moving forward, we want to look into social infrastructure, housing, roads, hospitals, schools, and the challenge is to create models that attract international and private finance to fund and deliver these projects, and which provide the government and the people of the region with the services that are needed. And so finding models that work is one of the themes. The second theme is what alternative sources of funding are available.
More than a quarter of organizations in the Middle East have experienced economic crimes in the past 24 months, lower than the global average of 36%, but a 5% increase since 2014, according to a new report. The latest PwC Middle East Economic Crime Survey said that despite efforts to combat economic crime, there has been no clear indication that levels in the Middle East or globally have decreased since 2011. According to the survey for 2016, the number in the region who simply didn't know if they'd been a victim was much higher than the global average, indicating uncertainty as to whether their organizations are experiencing economic crime. The survey revealed that 30% of organizations have been affected so far by cybercrime, and 39% think they will be affected in the next 2 years. Cybercrime remains the second most reported economic crime. PwC said most companies are still not adequately prepared for or even understand the risks faced, with only 33% of organizations having a cyber incident response plan. The survey said a fraudster in the Middle East is most likely in middle management or a junior role, while the types of fraud more prevalent in the region include misclassification of payroll expenses, false wage claims, and fraudulent reductions in payroll taxes. The survey also showed that 92% of respondents in the Middle East say they don't see bribery as a legitimate practice in their organization, and 83% of them saying they would rather lose a sale than pay a bribe. According to the survey, 1 in 4 organizations have not carried out a single fraud risk assessment in the last 24 months, while 17% are discovered by mere accident. The Habtoor Group has held a sales launch for the residence collection of apartments at its $3 billion Habtoor City project at the junction between the Dubai Water Canal and Sheikh Zayed Road. The residence collection is made up of 3 towers under construction behind a 3-hotel complex on the same site. The residential towers, which have been designed by Atkins, contains 2 74-floor towers and a 52-floor tower. Combined, the 3 towers contain more than 1,000 units, including 12 penthouses. Construction of the towers began 2 years ago, and Habtoor Group had said that handover of the apartments will take place from early to mid-2017. Habtoor Group opened the first of 3 hotels on the same site last December. Last month, Damac Properties unveiled plans to build a 7.4 billion dirham 6-tower complex known as Icon City on an adjacent site.